Good morning to you all. I hope all of you have joined with today's session. Shall we start? Can you see my screen? PowerPoint slides? Okay.
You can
Uh,
start.
okay, let's start. In the last class, yesterday, we have discussed about the basic of introduction part of the working capital management, and also at last we have discussed the working capital concepts, type of working capitals. And now we are looking to move and working capital management. Here, the working capital, sometimes it refers as a short-term finance, short-term investment. So working capital management or short-term financial management is the management of current asset as well as current liabilities. Here, the current assets includes the inventories, meaning stocks in hand. It may include raw material, work in progress, finished goods, account receivable. When we make sales on credit basis, our customers will pay the money in future. That is called account receivable. And the marketable securities, if we have an excess money, we put the money in the bank as a fixed deposit for the short period of time, say 3 months, 6 months, but it should be less than 12 months. And investment on treasury bills and so on. And cash includes both cash in hand as well as cash in bank account, especially in current account. And at the same time, the current liabilities includes payable, notes payable, uh, accruals and account payable. So if the obligations which are falls within 12 months, we have to settle it. So if we purchase raw materials on credit basis, we have to settle it back. Then it will become as account payable. Sometimes we have to our eh, pay to our employees for rendering his service to us. We have to pay. Sometimes we have to pay tax, deferred tax. It also an obligation, and the bill payable also include under the account payable. It's coming under the short-term current liabilities. Firms are able to reduce financing cost or increase the fund available for expansion by minimizing the amount of funds tied up in working capital. So as a financial management students, I don't want to explain again what is investment decision, financing decision, dividend decision, and the working capital decisions. You already studied well. And here, for the purpose of making profit, long-term profit, they are invest in a long-term investment, long-term non-current assets. So it will give them more profit. So working capital actually is not an investment. It's not a profit-making investment, right? The working capital is the amount of money that requires to run day-to-day business activities, right? We, as a company, we expect profit from non-current assets, investment, long-term investment. So keep in your mind that the working capital is amount of money that is required to maintain the business on daily basis. So if we when we accumulate more capital on working capital, when we accumulate more money, more investment on working capital, it will make it will not make appropriate income. So as much as possible, we have to reduce the amount of investment in working capital to reduce opportunity cost and so therefore we have to increase the investment as non-current assets for making profits, right? Not net working capital fund, right? Net working capital fundamentals. So net working capital, so as I explained you in the last class, So there are two main concepts, gross working capital and net working capital. So simply, gross working capital means the total amount of current assets. We are not compare this current asset with current liabilities, right? But net working capital, in other hand, we net value, current assets minus current liability. The balance sheet figure is called net working capital. So working capital refers to the current assets which represent the portion of investment that circulates from one form to another in the ordinary context of business. It's mean the day-to-day business activities. And the net working capital is the difference between the firm's current assets and its current liabilities. It can be negative or positive. So most of the time it should be positive. Otherwise they will go for insolvency in the short term, right? When we talk about manufacturing companies, all the times they have they are half 50% of total assets belongs to current assets. And difference in the management of non-current assets and current assets. So managing working capital, managing current assets is different from managing non-current assets. So you have studied under the investment appraisal, right? You have calculated NPV, IRR, accounting rate of return. A lot of stuffs we have studied to appraise whether the investment is viable or profitable or not. For that you have used discount factor also, cost of capital, discount factor, that sort of stuffs, because of its long-term decision. But working capital is not a long-term decision, it's a day by day, right? It's a decision on daily basis, short-term basis, some monthly basis, right? So first, in managing non-current assets, time is very important factor. Consequently, discounting and compounding techniques play a significant role in capital budgeting and a minor one in the management of current assets. In the current assets management, working capital management, we are not apply time value of money concept because it's very short period, right? And also we are not using any compounding or discounting NPV. No, that we are not apply that kind of stuffs here. When we compare with the management of non-current assets, working capital current assets management is very narrow one, but very important one. If they fail in effectively managing working capital, they will end up with loss. And the second, the large holding of current assets, right? When we put our money investment on current assets, as I told you earlier, it will not contribute much on making profit. The profit making investment is on non-current assets, right? Not working capital. So second, the large holding of current assets reduces the overall profitability. Thus, the risk-return trade-off is involved in current assets. So we have invested our money in current assets, therefore we have to care about on risk-return trade-off too. And third, the level of non-current assets as well as current assets depend upon expected sales. But it is only the current assets which can be adjusted with sales fluctuation in short run. Thus, firms has a great degree of flexibility in managing current assets. Right? Every month, it fluctuates. The level of inventory and case receivable, payable, everything is fluctuated over the month. Within the period, there are many fluctuations, unlike non-current assets. So non-current assets, we cannot observe a frequent fluctuation there. And now we'll move to the objectives of working capital management. To run efficiently with as little money as possible tied up in working capital. So So our objective is if you are an efficient manager, financial manager, as much as possible you have to reduce the amount of investment in working capital because it not make any profit. It involves a trade-off. Trade-off means a balance, right? Balance between two contradicting figure. That is trade-off, right? It involves a trade-off between easy operation and cost of carrying short-term assets. If you have more investment on working capital, it's easy to manage your daily business, but you have to lose your profitability. And the opposite side, if you are maintaining low level of working capital in your organization, in your company, and it's very hard to manage the business on daily basis, but you can end up with higher profitability, but it's risky. Keep it in your mind. And the benefit of low working capitals are money, otherwise tied up in current assets, can be invested in activities that generate higher payoff. Right? You can invest that money in profitable investment ventures. It's mean on current assets, and reduce need for costly financing. So every rupees you are using in your organization, it has its own cost. So if you reduce your investment in working capital financing, so you can save some sort of cost. And cost of low working capital. If you are maintaining a low amount of working capital, so you will end up with risk of shortage in cash and inventory. And right. Now we'll move to significance of working capital management. In typical manufacturing firm, current assets exceed one half of total assets. So I told you earlier, when we look at the management manufacturing organizations, we can observe more than 50% of its investment on current assets. Excess level can result in a substandard return on investment, ROI. It will impact, finally, it will impact on ROI. Is one of the most important performance measure. If you invest more capital on current assets, it will impact on ROI, adversely impact on ROI. Current liabilities are the principal source of external financing for small firms. So what do you mean by source of external financing? Current liabilities, right? Current, for small firms, uh, account payable is one of the best ways of financing on working capital. Say you are going to run a business, right? Uh, and to start up the business, you want inventory, isn't it? If you have money, you can buy the inventory, you can keep the inventory in your shop, and you can sell it to your customer, and you can make profit. But think about, if you don't have enough money to buy inventories, so what is the best option for you? What's that? What's the option? You can get the inventory from your supplier on credit basis without paying money at the time of purchase of inventory. You bring that inventory in your shop and you keep the inventory for a period of time, and you sell the stock to your customer, and you get the money, and you pay your uh, obligations, payables to your supplier. It's a best way. It's one of the best ways of financing working capital through current liabilities, right? And it requires continuous day-to-day managerial supervision, unlike non-current assets. So we have to think more, and we have to make a thorough analysis when make investment decisions. But unlike that, working capital management need day by day continuous monitoring, supervision in working capital. Working capital management affects the company's risk, return, and share prices. So, as you know, ultimate objective of financial management is to maximize shareholders' wealth. So, the efficiency of managing working capital finally impact on share price at the end. Right. Now we come to the most important area in working capital management, uh, choosing the policies. So, what amount of working capital we have to maintain in our organization, right? So, working capital issues. The thing is, the duty of the financial manager regarding the working capital management is they have to choose the optimum level of current assets, not more than needed, not less than we need it. We have to maintain an optimum level of current assets. Here you can find a graph in the slide. Here in the vertical axis, the level of assets in terms of monetary value. It's here dollar, and in the horizontal axis, we can find the output, level of output, number of units of productions. And here you can observe there are three policies, working capital policies. So this policy uh, is determined on what basis? Simply, it's determined, the policy is determined based on the amount of current assets. Here we have three policies: policy A, policy B, policy C. Policy A is having a maximum amount of current assets, right? And the policy C is having the less minimum amount of minimum level of current assets, and policy B is moderate, right, playing in the middle. Here we have assumptions. So the company can produce maximum of 50,000 product units, and it continues production. It's involved in continuous production, not standalone or one production. It continuously produces. This means the company is running over the time. And there are three different policies for current asset levels are possible. Right, now we will see the impact on liquidity on the policies. Here, policy A. Policy A, they are having a high level of investment on working capital, high level of investment, and policy C is having less amount of working capital, less amount of investment on working capital. Assume that they are having cash in hand, right? So working capital is not equal to cash in hand. For your understanding purpose, here I tell you, assume, keep it set in your mind. Uh, Here I'm preferring working capital means the amount of money in hand for the understanding purpose only, right? Here the policy A, they are having high level of money in their hand. The liquidity is high. Liquidity is high. If the firm following policy C, they are maintaining very low level of money in their hand. Therefore, the liquidity is very low. And company B, policy B, they are having a moderate amount of money in their hand. Here, so what is the relations? The policy A is having high liquidity, uh, more money, more liquidity, right? More investment on current assets, it means more liquidity. And less investment on working capital, it gives low level of liquidity. That's a fact here. And when we talk about the profitability and the working capital policy, so policy A, we have higher amount of working capital, right? Uh, to talk about the relationship between the working capital policy and profitability, we have to have a clear understanding. We recall how do we measure the profitability. So the common measure, well-known measure, is return on investment, ROI. Simply, here the equation is the net profit divided by total assets. So we know the current assets is part of total investment, isn't it? The current asset is a part of the portion of current total assets. So the current asset include cash, receivable, inventories, etc. Here, when we calculate return on investment, yeah, uh, we divide the total assets into two parts, current and fixed. Here, as we explained earlier, the current asset will not contribute to making profit, will contribute to making profit. But here, when the portion of current asset increases, the denominator, the total asset will be increased and net profit will be reduced. Then finally, it is end up with lower figure of ROI, lower level of return on investment. Right. Now we compare the policies and the profitability. Right. Here, policy A, B, C. Here, profitability low, average high. When we have a high level of cash in our hand, so it end up with lower profitability, lower ROI. If we have more investment on current assets, it will end up with lower level of profitability. And we have invest a lower amount of investment on current assets. It means we are maintaining lower level of current assets. Then our profitability, ROI, will be high. Here, as current asset level declines, here when we move to policy A to policy C, when as the current asset level decline, total asset will be decline, and the ROI will rise, will increase. Right. Now we will look at on the impact of working capital policy on risk. So we know the financial management is all about risk and return, right? So now at this moment also we will look at the impact of working capital management on risk, working capital policy on risk. Right. Decreasing cash, keeping cash at minimum level reduces the level of the reduces the firm's ability to meet its financial obligations. More risk. If we are having a low amount of cash in our hand, we are unable to settle our creditors. We are unable to settle our bills. We are unable to pay the labor charges to our employees, and we are not having enough level of inventories in our shop. So what will happen? We end up with more risk, right? It leads to high risk. And see here, strict credit policies reduce receivables and possibly lose sales and customers. More risk. So we are not allowing more days to our customers to settle their money. So for example, we are not allowing any businesses on credit basis, only cash business we are doing. What will happen? There are a lot of competitors out there in the market, and our customers will switch to our competitors. They are giving more flexibility on settle their money. And when they are keeping lower level of inventory, what will happen? Lower inventory levels increase stock out and lost sales. Again, small risk here. We in our shop we are not keeping more inventories. We are keeping only less number of inventories. Then what will happen? Our customers come to our shop. We are saying no, no, stock out. We come tomorrow. We come next month. We come next week. Customers are not willing to wait for us. There are a lot of competitors out there, so they will switch to the shop. If we are not satisfied our customer, definitely they will go to the next customer. So finally we will lose our customer, then it will impact on our sales, then we will end up with loss. And here policy A means we are keeping a high amount of working capital, then we don't have much risk. So we have enough money in our hand, we can settle everything, we have enough inventories, we are allowing more credit terms, more flexible credit terms to our customers, then our amount of current assets will be increased, then the risk is low. And policy C here, they are keeping a minimum level of current assets. So therefore, they are unable to maintain enough amount of inventory, enough amount of money in hand, enough and very rigid credit policies on our customers. Then we are at high risk in the policy C, right? So risk increases as the level of current asset reduced. There is a negative relations, right? Now we will compare these three: profitability, risk, and liquidity at once. Here, policy A, policy A is having maximum amount of current assets, high level of current assets, liquidity is high, profitability is low, risk is low. And policy C, it's having a low minimum amount of working capital on their business, therefore liquidity is low but profitability high, and due to low liquidity they are facing high risk. So here risk and return relationship, here the policy A are facing low risk, therefore they ended up with a low profitability. And C, they are taking high risk and they are end up with high return, right? Here profitability varies inversely with liquidity. It means there is a negative relationship between liquidity and profitability, and profitability moves together with risk. So we know there is a positive relationship between risk and return. So risk and return go hand in hand. And classification of working capital. So based on the components of working capitals are cash, marketable securities, receivables, and inventories. And the time, based on the time, we can divide the working capital. We can classify the working capital as permanent working capital and temporary working capital. So I have explained in detail in the last class about what is permanent, what is temporary working capital. So the temporary working capital we require on the seasons, right? Right. Permanent working capital. The amount of current assets required to meet the firm's long-term minimum needs. Long-term minimum needs. So forget about the seasonal business. Forget about seasonal business. Say for example, textiles, right? Textiles, without considering the season in March, and April, December, January. So they have to maintain a minimum amount of inventories, cash in hand, and customers, right? For that, they want a certain amount of investment on current assets. It lasting forever, right? It lasting for long period of time. right, to run the business. So that amount is called as permanent current assets. That amount is permanent current assets. And here in the green line, it's a fluctuation. This fluctuation is arises due to the seasonal business. Say, for example, if you assume your business as a textile business, you can, here it may be in the month of December, November and December, right? Then your sales will come down, and April comes, March, April comes, a new year comes, therefore you are facing a big amount of sales. And again you are facing with other festivals, right? uh, Sometimes we call as a wedding seasons, right? Wedding season. So, and also that, so when you face seasons, you want an additional investment on current asset. You have to buy more inventories. You have to buy, you have to keep more money. You have to employ many people to serve there, and you have to give more credits, loan to your customers. So that time you have to keep a certain amount of current assets. That is called what? Temporary. It's not fixed. It requires on seasonal basis. So that portion of capital asset is temporary current assets. Right? Clear? Right. Now we will talk about financing current assets. Financing means where we are going to get money to invest on current assets. That means what? Financing, where we are going to get money to invest on current assets. Financing current assets. So there are two ways: short term and long term. Short term example is bank overdraft, right? Bank OD. And the long term, so either they can go for equity capital, on capital, or they can go for long term debts, not the short term. Long term debts. Short term debt is bank OD, right? Short term financing and long term financing is not a big issue for you because you already studied the financing decision under the financial management subject, right? Spontaneous financing. Spontaneous means come instantly without planning. Right? Without planning, it's come instantly. A trade credit and other payables and accruals that arise spontaneously in the firm's day-to-day operations, right? Without planning. So it's come automatically, right? Based on the policies regarding the payment of purchases, labor charge, tax payment and other expenses, right? It's come automatically, right? And we are concerned with managing a non-spontaneous financing of assets, right? So we have to manage. It comes on daily basis, right? We are concerned with managing a non-spontaneous financing of assets, right? It is very important, right? You might study a lot of risk management techniques, hedging techniques, especially in international financial management, how they hedge the foreign exchange risk and the interest rate risk. Likewise, we are going to use the same concept of matching hedging techniques. Hedge, right? Short-term short-term requirements, short-term assets is uh, financed by short-term source of finance. Long-term investments is financed by the long-term loans. So for example, for your understanding purpose, you are going to construct a house. Are you going for bank OD or long-term loan? What is your answer? Please, you can unmute your mic. We can tell the answer. You are going to construct a house. Option 1, you can go for bank overdraft. Option B, you can go for a long-term loan, 10 years loan or 20 years loan. So please answer. You can post your answer on chat box also. Make sure. Are you there, participants? Are you there in the class? Okay, one person, yes, long-term loan. Others, no idea. So long-term loan, yes, right? Um, we plan a trip, right? We to enjoy the holiday. We plan a trip. You need say 5 days holiday plan. Are you going for a 20 years loan or short-term loan? You will find money from your friends, or you are going for a bank loan, long-term bank loan. So what is your option?
Short term long, sir.
Short-term loan. So it's a matching. So short-term requirements is financed by short-term source of finance. A long-term financial requirements, so long-term investments is financed by the long-term financing sources. So it's called simply maturity matching, right? This is the logic behind uh, maturity matching concept here. In the For the forthcoming slide is dealing with the financing of current assets, working capital management. For that, we have to have a clear understanding of on this graph, right? We have to have a clear understanding of what is fixed assets, what is current assets, what is permanent current assets, what is uh, temporary current assets, and you have to clear about what is long-term financing and what is short-term financing. These are the very important concepts. Some people are confusing, right? So there are different concept. You have to have a clear idea, right? Here in this graph here, you can find dollar amount. So it's about the right side of the balance sheet, right side of the balance sheet. The right side of the balance sheet, you can find two set of assets, asset side. One is fixed asset, another one is current assets. Here this line, right, fixed asset is equal what? Fixed asset. Sometimes if you want, you can say as non-current assets. I don't mind. And you can keep current assets. You can keep current assets, right? Fixed asset plus current assets equal total assets. If the first line represent fixed assets, we are not concerned here because we are dealing with current assets. And this portion, right, current assets above the fixed asset, we have current assets. Again, the current assets are divided into two parts. Current assets are divided into two parts. The gap between the current asset here, this blue and green line, is what? The line between the blue line here, this level, and the green line, short term finance. So what is it? What is that? What is that here? Here we have current total fixed assets, right? Fixed asset. Here we have current assets. Current asset has having two portions. One portion here, it requires all the times. So what's the gap here? This gap is what? Anybody else? Anybody else? Anybody else? The gap between this line, these two lines, is equal what? Equal what? So you know this is what? This one. So temporary working capital, isn't it? So temporary working capital. Temporary working capital is financed through what? What the mean? Means of financing is short-term financing, right? And this portion is what? This portion, you can unmute your mic and you can answer. It is not one-way communications, so you have freedom to ask questions, right? You have to respond. Otherwise, we can't have a good session, right? So what's the portion in this? This portion, permanent current assets. Good, Mr. Amir. Yeah, replied. Yes. This portion is what? Permanent current assets. And this portion is what? Temporary current assets. Temporary current assets. This understanding is very, very important, right? Here, in the maturity matching approach, there are three approaches. We have studied that there are three policies A, B, C. So I will explain what do you mean by that three policies. There are three names for each policies, right? Here, you observe here the permanent portion of current assets is invested, financed by what's the source? Financed by which source? Please respond. You can unmute your mic, you can talk freely. So permanent portion of current assets is financed by which means?
Long-term
Very
loan.
good. Yes, permanent current asset is financed by long-term financing. And here the short term, the temporary working capital is financed by which means? Short-term financing, right? So it's very clearly this policy maturity matching concept or hedging approach means the short term, the temporary working capital requirement is funded by short term means of financing, and the permanent working capital is invested or financed by long term financing. Clear? That is called a maturity matching or hedging approach. This is number one. A method of financing where each asset would be offset with a financing instrument of the same approximate maturity. So long terms mean permanent current assets. It's financed by long term financing, and the fluctuating working capital, which means temporary working capital, is financed by short-term borrowings or loans. And we move to the next slide. Here, the less amount of finance spontaneously by payable and accruals, in addition to spontaneous financing payable. Here it is a permanent. It says it's a permanent portion. It's a temporary portion. Right. Financing needs and hedging approach. Here, fixed assets and non-seasonal portion of current assets. Here explained very clearly. Fixed assets and non-seasonal portion of current assets, permanent current assets. Fixed and non-seasonal portion of current assets are financed with long-term debt and equity. It may be long-term loan, long-term debt, 5 years, 10 years loan, or equity. So long-term profitability of asset to cover the long-term financing cost of the firm. So we know that the long-term finance is having higher cost than the short-term debt, right? All the times a long-term investment and long-term financing is having higher cost of capital, right? And the seasonal needs are financed with short-term loans. Under the normal operation, under the normal operations, sufficient cash flow is expected to cover the short-term financing cost, right? Then the self-liquidating nature of the short-term loans. What do you mean by self-liquidating nature? Self-liquidating mean, right? You invest your money to buy inventory. Earlier, it is in the form of cash, money. The money become inventory, right? You keep the inventory for a period of time. Inventory is considered an asset. And when you make the sales on credit base, to your customers, then the inventory become receivable. Again, it's an asset. Inventory is become an asset, current assets. When your customers settle the money to you, and you will realize money, you will get the money, and the money will be goes to your suppliers if you are purchased inventories on credit basis. Here's a rotation. No, the self-liquid inventory against become money, inventory become liquid asset. Seasonal order requires the purchase of inventory beyond the current levels. Seasonal fluctuations for during the season, we are facing a high level of sales, so therefore we have to keep more stocks. Seasonal orders require the purchase of inventory beyond the current level. Increased inventory is used to meet the increased demand for the final product. If you are a manufacturing organization, during the season, you have to purchase a big amount of inventories. Say for example, if you are a textile businessman, you are producing garments, during the season you have to buy more materials, right? You have to buy more materials to make garments, apparels, and sales become receivables, and receivables are collected and become cash. The resulting cash funds can be used to pay off the seasonal short-term loans and the cover associated long-term finance cost, right? So based on the profit, you will cover the short-term cost of finance as well as a long-term finance cost. Right, now we will see the risk and cost. So when we are having more risk, if we are maintain low level of working capital, it gives high risk. So low level of working capital, high level of risk. And when we are keeping high level of working capital, and it is low level of risk, but when we are keeping high amount of working capital, it generate more cost investment. No, to maintain high level of working capital, we need financing. The source of financing is having its own cost of capital. So in the conservative approach mean, right? First we will understand what is conservative approach. Here earlier we have discussed about what approach? This one, hedging approach or maturity matching approach. This is approach number one. So in our graph, this policy it's applicable to policy B. Now we move to the next policy, that is conservative approach, right? Conservative approach, the second policy. Here, see the line. Earlier, the line was here at the edge of the source, the seasonal fluctuation. Now, the line is go up. Have you observed or not? Are you observing? Are you observing? Yeah, the line is go upwards here. Earlier, the line was here. Now, the line has moved up, right? Here, when you look at here, the fixed asset is financed by long-term finance. Here, the short-term fluctuations are financed by both short-term financing as well as long-term finance. In the maturity matching concept, maturity matching approach, only permanent working capital are financed by long-term financing, and short-term financing, short-term fluctuate, short-term current assets are financed by short-term borrowings. But here, part of seasonal temporary working capital is financed by long-term borrowing. Part of part of uh, temporary working capital is also financed by long-term finance. Clear? That's why the line is moved upwards. Yeah. So here they are having surplus cash. Here deficit, here surplus cash. So here deficit and here surplus cash, right? So the total current assets has having two portions. First portion is temporary working capital and permanent working capital. Here the temporary working capital or part of temporary working capital also financed by long-term finance. That is called a conservative approach. Firm can reduce risk associated with short-term borrowing by using a larger portion of long-term financing. Right. So I have one question. Short-term borrowing is risk or risk? Short-term borrowing having high risk or low risk? Anybody of you, finance students? Short-term borrowing is high risk or low risk? Any answers? Response from you? So when we go for a long-term bank loan, the interest rate is fixed, right? And for the short-term loan, the rate of interest for the short-term borrowings, it fluctuates over time. It is profitable to get a short-term loan at the time of a lower interest rate, when interest rate is low, and it is risky when we are getting short-term loan when interest rate is high. So obviously short-term loans borrowings are a little bit risky than the long-term borrowings, right? Before that, yes, the long-term financing, long-term, we are applying long-term financing benefits. What is the benefit? The conservative approach, we are employing more long-term funds financing. So for example, we are employing more equity capital or more long-term debt capital. So if when we are employing, what are the benefits? Less worry in refinancing short-term obligation. We are not worried because we don't want to settle the debt immediately, right? We are getting the long-term loan, so it's not rush for us. And less uncertainty regarding the future interest cost due to the fluctuation of interest rate. And other side, the risk, the borrowing more than what is necessary. Here at this point, we have, if we are borrowed from the long-term fund, Here we borrowed additional money, useless. We are surplus money. Here surplus, here surplus, right? Here, sorry, here surplus money. They are having surplus, surplus. Here deficit, deficit. Deficit is no issue, but the surplus. So they are getting fund from the long-term financing mode. Therefore, the long-term financing mode is all the times associated with high cost of capital. But we are investing here in short term. So borrowing more than what is necessary and borrowing at higher overall cost usually. And the result is a manager accept less expected profit because it will severely impact on ROI. Manager accept a less expected profit in exchange for taking less risk. And the next approach uh, is aggressive approach. Aggressive, right? The third policy. They are maintaining very low level of current assets. Here in the graph, we can explain like this. Here, so what you observe here, the line, the portion of permanent current assets is reduced. Permanent, the level of permanent current asset is reduced, and the portion of temporary financing, yeah, the portion of permanent current assets also financed by short-term financing, right? Get a clear idea. The permanent, right? The permanent working capital requirement is financed by long-term financing as well as short-term financing. Permanent assets, permanent working capital permanent working capital is financed by both long-term financing as well as short-term financing, right? All right. And here, when you look at the picture, all the times they're struggling. You know, they are struggling all the times. They want to go for a short-term financing. All the times they are working with OD. Right. Short-term financing benefits. Financing long-term needs with a lower interest cost than the short-term debt. Right? We know it's obvious. The short-term debts all the times, most of the times, having the low interest rate when compared with long-term loans, and borrow only what is necessary or when is necessary. So when we require only, then we can take the loan. Otherwise, we don't go for a loan. And the risk, refinancing short-term obligation in the future. Every day, all the times we have to settle the credit, settle the payment. And uncertain future interest cost. If the interest rate is increases in the short term, so it will make another burden to the managers. And the result, managers accept greater expected profit in exchange for taking greater risk. All the times there is a rush, right? And here is a summary of short-term and long-term financing. Here, asset maturity. Here there are two portion of working capital. One is permanent working capital and is short-term temporary working capital, sometimes called fluctuating working capital. And there are two ways of financing in that working capital. One is short-term financing, say for example bank overdraft, and the long-term financing, say equity financing. Here, short-term temporary working capital requirement is financed by temporary short-term borrowings. Here is what? Moderate risk and profitability. So it's fall under which category of working capital approach, financing approach? Aggressive or conservative or matching? Which one? Any answers? This portion falls under which policy? Which policy it falls under? Please respond. It's a hedging, no? Short term with short term, long term with long term. Long term investment is invest by long term financing is these two are what maturity making concept approach. And this one, the long term financial requirement is funded by short term financing. Is what this is what which approach? This is which approach? Long-term financial requirement is funded by short-term source of finance. Any answers?
Aggressive.
Very good. Aggressive policy. And here on the short-term finance, short-term temporary fluctuation of working capital is funded by the long term. So this is which policy? Which falls? This portion falls. Which policy? Any answers? It's a conservative policy. It's a conservative policy. So do you have lectures at 10 o'clock? Any other lectures? Combining liability structure and current asset decisions. So the level of current assets and the method of financing, those assets are interdependent, right? And a firm that follow a conservative policy of maintaining high level of current assets. So we know the conservative policy means they are maintaining high level of current assets, which is financed by long-term financing sources, and high level of current assets should be in a better position to successfully utilize short-term borrowing than firm that maintains aggressively low level of current assets. And the conservative method financing, it's mean they are financed by all equity, allows an aggressive policy of lower level of assets. And case conversion cycle, aggressive versus conservative. Here we are talking about only, hereafter we are talking about only two policies. Do you have lectures at 11 o'clock? Do you have lectures? If you don't have lectures, we will continue. No idea. Shall we continue? Okay, we will continue. Right. And yes. Yeah, conversation case conversion cycle, aggressive versus conservative seasonal funding strategies. And the aggressive funding strategy is a funding strategy under which the firm funds its seasonal requirement with short-term debt and its permanent requirement with a long-term debt. So, what is the most suitable policy here? Here, if they put the aggressive funding policy. So, I I call for an open discussion from all of you. Say actually, it's what policy? So, it's funding strategy under which firms fund its seasonal requirement with short-term, yeah, seasonal requirement with short-term debt and the permanent requirement with long-term debt. So it's what kind of policy?
Maturity.
Yes, exactly. Maturity, right? Its maturity matching concept is close with aggressive funding policy, right? We are not talking about maturity matching anymore, right? And so maturity matching policy is very close with aggressive funding strategy, and the conservative funding strategy is it's mean we assume that most of the working capital requirement is funded by the long-term financing. So conservative funding strategy is a funding strategy under which uh, the funds both seasonal and its permanent requirement with long-term, right? Both seasonal as well as permanent working capital requirements are funded by long-term debt, right? And now we will move to these calculations. Case conversion cycle and aggressive versus conservative seasonal funding, right? And I will give you 5 minutes, and please, I will unmute my mic. Uh, I will mute my mic, and you can unmute your mic and discuss how the answer comes. So, what have you understood? So, the answer is here. Question is here. So, I call for you open a discussion among you. Hope I will explain. Right? I will explain. I will give you 5 minutes. And now 10:30. Uh, so before 10:18, you should finish your discussion, and I will explain. Right? Right? Are you ready? Right. I will explain. Do you want explanation? If you everybody understood, I don't want to explain. Do you want? Do you want explanation for this answer? And okay, yes, of course, it's my duty. Okay, and case conversion cycle, aggressive versus conservative seasonal funding strategies. Here, SP, the name of the company, has a permanent funding requirements and of 135 in operating assets, and the seasonal funding requirement with varies of 0 to 990, right? Right, and the average of 101,250, right? Please note it down. Permanent requirement 135, and the seasonal funding requirement is 990, and the average 101. So take a piece of paper and take the note on this. If SP can borrow short-term funds at 6.25, if they go for a short-term bank loan, it will charge 6.25%, and for the long term, if they go for the long-term debt capital, so it will cost 8%, and if it can earn 5% on investment of any surplus balance. So if you have additional money, you can invest that money into the bank on fixed deposit or whatsoever, or saving account, or you can buy treasury bills, and from that you can earn 5%. Then annual cost of aggressive strategy for the seasonal funding will be, so so what we have to understand the difference between conservative and aggressive policy to answer this question. So I will open a whiteboard Can you see the whiteboard? Right. So here it's amount of money, right? Here money, rupees. Here the what's called time, right? So it's fluctuate like this now. The first question is the which policy? First part. First part is which policy? Aggressive or conservative policy? Aggressive or conservative?
Aggressive.
Yeah, I mean aggressive mean most part of the more part of the investment on current assets are financed by short-term borrowing, right? Here this is permanent one, no? Permanent one. How much permanent capital? How much?
35.
135 million, right? I'm very sorry, I unable to draw the picture clearly, but it range the this is what? So this amount is a permanent working capital. It's a permanent. This is what? It's a temporary, right? It's a temporary. Temporary working capital. Uh, what's the range of working capital? Maximum range. Maximum. What's the level? It varies between 0 to how much? 0 to 0 to
990.
good 990. So therefore 135 plus 990 how much? 135 plus 990. That's a variation. No? How much? It's equal. How much? 135 plus 990. It's equal 1125. Right? 1125. Right? So set the difference here. The difference between here is equal 990. Right? Keep it in your mind. 990. And yes. And average, they are maintaining average how much? Average working capital requirement. How much average? Average requirement how much? Normally they maintain how much? The question. On average 101.25. 101 2, right? 101 how much? 101.25. Right? Uh, right. Then so under the aggressive policy, all this portion, all this portions, all these portions are financed by, on which form, which method? This amount 135 financed by which, what's the mean? The way is what? Long term or short term in the aggressive policy or matching. You assume that aggressive policy, they are mentioning, they are mean that the matching concept, right?
Mhm.
So long term of short term financing. This permanent working capital funded by, so long term. No, what's the cost? What's the cost
Eight
of?
percentage.
Yes,
Eight
then
percentage.
yes, good. So therefore, 135,000 into 8% is called what? It is that is equal to long term cost. So see the slide. Say cost here. Cost of long term financing. It's 8%, right? 8% into 135,000. We got 10,800. Clear? I hope you will get clear, right? And here, see the whiteboard, and how much the average temporary working capital requirement, how much? Or the how much? 1,000, 101,250,000. Sorry, 101,250 rupees, and it is financed by which means short term or long term?
Short term.
Short term. Short term mean what's the cost of finance? How much?
6.25.
6.25. So this amount, it's financed by short-term financing. So that's the cost of 6,328. And in the conservative policy, do they maintain any additional money, surplus money in the working capital? Do they maintain?
No.
No. So therefore zero. Then how much total cost? 17,128. Clear? Clear? The aggressive
Yes,
policy.
sir.
Then right, good. Then we move to this. So it's different mean here, the conservative policy here, all both permanent as well as a temporary working capital is funded by long term finance. They not go for short-term borrowing. But if they have an additional money during non-season, if there is no season, they will end up with additional money. They're keeping surplus money. That surplus money will be invested at what percent of interest rate? If we have
Five
additional,
percentage.
very good, very good. Right now we move to the slide. We move to the whiteboard here. Um, I repeat again, their permanent working capital requirement is 135, right? And it varies, the variance 0 to 190, 190. So 135 plus 190 equal how much? 1,100 and, so 1,125,000, isn't it? 1,125,000. Agree? Are you all agree? Are you all agree with me?
Yes, sir.
Yes, good. Good. Then it's mean the total. So all this 1,125,000, it's totally financed by short term or long term or both in the conservative policy. Combination of short term or long term or totally long term. So based on your response, I can understand your level of understanding.
Long term.
Yes, good. So therefore, the long term cost how much? Long term cost here. Uh, I choose conservative strategy under which surplus cash balance are fully invested, this surplus will be the difference between the peak of 1000. It's same answer. Now we are getting 135 plus 99 equal 1000, 1,125,000, isn't it? Yes, the answer is tally. And the total need which varies between 135. What's mean 135? 35 mean what? This is what? Permanent working capital, isn't it? It's a permanent working capital. And the difference is what? 990. Have you observed? The difference between permanent and peak of seasonal one. This one. Here, the permanent equal 135, right? It's a peak 135 plus 990 equal 1,920, 1,125,000. So this variation equal 990. It varies from 0 to 990. The top level 1,125,000, a minimum level 135. It varies between this, and they have to keep which amount in hand? They have to keep 101,250. Are you agree? On average, they have to keep in their money in their hand. I agree.
Yes, sir.
Yeah. So in the conservative policy, do they go for short term? Yes or no? Do they go for short term borrowings? No. Then they are not. They don't want to go for short term borrowing, but they have surplus money, isn't it? During the non-seasonal period, they will have surplus money. That's if they have surplus money, they will invest the money on the bank at what percent of interest? 5%, isn't it? They will invest at 5%. The trick here, the trick in this question is to find the amount of surplus money. The amount of surplus money. How do we calculate the surplus amount of money? It's very simple. It is very simple. Here, now he is having on his hand 1,125,000. They have to keep the money how much? 135 plus 101. How much? Normally they have to keep what amount of money? How much? 135 plus 101. 25. How much? So 135 is for the permanent capital they want to keep, and they want additional 101,250 for the fluctuation, right? It's average. Then how much they want? Total they want how much? How much they want? Any answers? Permanent 135 plus fluctuating working capital 101, 25. Then how much? Can't you understand my question? Any answers?
2,36,250.
Yes, 236,250, right? 135 plus 135 plus 101, 250 equal 236,250, right? That's a requirement. They have one. Yeah, they already have 1,125,000, right? The requirement is how much? 236,250. 250, isn't it?
250.
Yes. Then sorry, how much balance they have? Surplus they have? How much surplus? Surplus? On the hand, this amount, the requirement is this amount. Then how much?
750.
750, not 750.
No.
No.
8 lakhs
Yeah,
808.
yes. That's the answer here. So here, so they have to maintain up to this level, no? Here, so they have this amount of money. This is what? This is surplus. This is surplus. This portion is surplus, and this portion is the requirement. This portion is the requirement, and the upper portion is the surplus. The surplus equal 800. How much? 888. No, right. So that is surplus. So surplus money will be invested at what percent of interest rate? What percent of interest rate?
5%.
5%. Good. Here, so they don't have enough. They don't have. They don't want to go for any short-term borrowings. Therefore, there is no. That's zero. And long-term financing. All the required funds are taken from the long-term loan at the percent of 8%. At the rate of 8%. So therefore, the cost of long-term borrowing is 90,000, and they have additional fund 888,750. So it can be invested at the rate of 5%. So this is what? Earning. So cost minus earning. Earning is 44,437. So how much cost? Cost of conservative strategy, cost of capital, cost of working capital, how much? 45,526.5. Clear? Is it clear?
Yes, sir.
Okay. Others, what about others? Are you all clear? Others? If you are
Yes,
unable,
sir.
okay. Then if you are unable to switch on the mic, you respond at least through the chat box. Otherwise, I unable to. If only one or two of you are interact with me, so it's mean I teach only that few people. Oh, I assume that only two people are here. Others are mute the mic and do the work. So right, and good. And next one, next slide. Yes, case conversion cycle, strategies for managing the case conversion cycle. So as efficient manager, efficient financial manager, they have to manage their fund efficiently. It means they have to minimize the length of conversation. So as I told you in the exam, yesterday's example, phone shop. So one person buy the phone, keep the phone in 2 days, and sell to customers and collect the money immediately. So the person one having the short conversion period. The person two, they are buying mobile phone, keep the mobile phone for 1 month and sell it to the customer and collect the money after 1 month. So when we compare with person one and person two, uh, the person one is having the shorter conversion cycle. Shorter conversion cycle. Therefore, he can rotate many times in a year, right? In a year, and that person, the first person can have 15 times conversion cycle, but the second person having only one cycle every 2 months, right? So the goal is to minimize the length of case conversation cycle, right? So minimize, the goal is to minimize the length of case conversion cycle with minimizes negotiated liabilities. This goal can be realized through one of the following strategies. Here, the first strategy number one, turnover inventory as quickly as possible. Don't keep the stock inventories for a long period of time, right? So try to sell the inventory as much as possible, right? Quick as much possible. And without stock out, that result in uh, lost in sales. If you are keep stocks more in your shop store, so it will tight much of your capital on the stock working capital. And if you are invest low, if you are keeping minimum level of inventory, you are unable to satisfy your customers, they will switch to your competitors. And collect accounts receivable as quickly as possible. So if you give loan to your customers, so you have to get the money speed as much as possible. So if you tight very much, the customers will switch to your customer. So you have to maintain your customers reputation, right? And manage mail processing and clearance time to reduce them when collecting from customers, and increase when paying suppliers. So, right. So in case of settlement, if you purchase anything, you have to settle the money, no? So when you settle the payment, you have to delay the payment. And when you collect the money, you have to speed up the collection of money, but when you pay the money, you have to slow down and pay account payable as slowly as possible without damaging the firm's credit. And you have to keep in your mind, when you delay more and more the payables, and the suppliers will not give you inventories, raw materials on credit terms. And so that is the next section, operating cycle. I think we can start it in the next session. So I think it's enough today. So I will send you a link, then you can fill the form. Uh, right. Yes, I will send you a form. Mm. Right. So I will send the form. You just type your last name here. You type your last name, not your full name, your last name, and your registration number, your last number. No need to type SCUIS. No need to type. You just type the last number, right? So then your attendance will be recorded automatically, and it will reduce your unwanted burden. Here I will send here. Right. Hope all of you are getting the link here in your chat box. You just click the link and you can fill the form. Then your attendance will automatically record it. Any questions to ask? Anything to ask? Anything to ask regarding this section? What we discussed today?